Welcome everyone to the Kendall Report. It is Sunday, very early, 3 o'clock in the afternoon Pacific time. So we're starting early, trying to get this schedule going. I think this will work. We'll see how it goes forward on the Sunday is going to be the real question. And just a quick announcement, I could be about an hour late tomorrow. I have something that's come up in the afternoon I have to deal with. So just be prepared. I will tweet out about an hour or so before I'm coming live tomorrow. So it might be a little bit late. The rest of the week should be normal. We got a lot ahead of us again here, folks. Wow. We have the Fed, we got CPI, PPI. We've got a lot. And it's interesting how everything's setting up. The folks, I hate this term, by the way, that we're looking at, we're up 20% from the lows. Now we're in a bull market. And the real answer was we've been in a bull market. Markets tend to move between 20 and 30% in these good moves. So there's still more on the upside. We've certainly seen the NASDAQ, up just looking at the notes here, 27 or basically 27% up on the year. So if it stabilizes and flattens and maybe everybody else starts to catch up, that'll be the thing. The title of the video tonight is, Can the New Leadership Keep On? And that's the Russell. The Russell was flat on the year just a couple of weeks ago. We're now up 6%. And what's it all about? It's about the banks. I've been telling you that the banks are going to be your big opportunity there. And there's definitely been some nice movers in that sector. And I expect that to continue on. And I don't see much going on, as we'll get into talking about the Fed meeting here in just a minute. But there's really everything's forward, right? You'll see here in a minute, the Wavetech database continues to get traction, just like I expected. I talked about on Friday's video. So everything's moving forward. And as much as the folks out there want you to believe that it's not going to move forward, it is. And it's interesting because there's a lot of folks, like a good buddy of mine is very negative and talking about how long it takes for macro trades to work and all that. Yeah, they take so long to work that you end up going bankrupt waiting for them to work. So that's the problem with some of these long-term trades. And anything that, when I've talked to you folks about this before, I look at investing as like driving a car on a dark night with no moon. You want to trade as far as you can see forward, and I don't believe you can see much further forward, or you need to see much further forward than about 3 to 6 months from a trader's viewpoint, okay? And even when you're managing a portfolio, if you have a good feel for 3 to 6 months, that's max. No one knows what's going to happen even in 3 or 6, much less 3 years from now. And maybe you get lucky once in a while. I've done that. I've been lucky at predicting longer term markets, and I do the longer term analysis. And that really, I try to really look out maybe 2 quarters, not get too far ahead of yourself, because that just puts you into, what happens is you can get into a psychological mess inside your head. And trading, and I told everybody who's ever been in my live trading room, is that trading, discretionary trading, is the hardest thing you'll ever do. It's nearly impossible just because of the emotions that constantly come into play. And you're looking at a guy that fell into that in 1980, and I started developing trading models, and my first trading models in 1981. And why? Because I wanted to eliminate the emotions from the trades and the decisions, and try to get more from a standpoint, have a program to walk forward, have a strategy, all that stuff. You hear it all the time. Well, I did it. And what I did with it is I incorporated it into software. So I put all the trading models in. Not only did I put the trading models, when to buy and sell, but how much to allocate to the trades. We figured out some formulas on that has really been crazy good for decades, folks. But the reason why I tell you about that is you really have to be careful looking too far ahead. And I think if you do just kind of focus on what's in front of us, that's the case. Now, if you can remember going back just maybe 6 weeks ago, we were talking about getting to 4,300, and I'm still targeting 44, 45 for the short term. We're still seeing some upside from that standpoint, basically because of the traction on the database that I'll talk about here in a few minutes. So let's do this. Let's talk about the economics that are coming out this week, and then what we'll see as we'll look at the some of the other elements around the Fed and expectations around that. So CPI is expected on Tuesday. There's really nothing tomorrow. CPI plus 0.1. Wednesday is PPI plus 0.1. And I think these year-over-year numbers are just going to stay somewhat flat. And that's not good enough for the Fed. And I'll discuss that more here in a minute. They're not going to be happy with that number flat. That's not what they're looking at. Thursday, we have retail sales expected to be up 0.2. We got claims, which was everybody got excited about the claims last week because they ticked up 30,000, even though the continuing claims were down 30, almost 35,000 to offset that. The continuing claims came in at 1.757. They were pushing around 1.8.5 or so. So they're continuing to come down, and that's more positive for the labor force than it is negative. Everybody grabbed a hold of that increased number, and that's it. That's the one data point that's going to cause the Fed to pause. Maybe. I don't know. I'll talk about that a little bit more, but let's finish what's coming out here in the economics. And then we have industrial production expected to be up 0.1, capacity utilization 79.8. And I'm telling you, that's number, and I mentioned this, I think if you watch the channel, and you may recall me saying this before, but that capacity number at 79, that's about as good as it gets. I mean, it really doesn't get much better. And I think it's interesting because I keep seeing things around the economy that people are talking about the expected recession. Well, we're expecting a recession. I mean, yeah. Anyway, the expected recession probably isn't coming. Maybe the recession is never coming. And these labor numbers are big. I'm not saying there's not. You can pick up a couple data points and say, oh, there it is, Bob. That's your recession. I don't see it. And I've been talking about this for a while. But I'm looking here. The other thing that comes out on Friday is the U of M, the University of Michigan Consumer Sentiment number. That's expected to be at 60.4. That doesn't sound like a recession either, folks. Let's be serious about this. And you know, the folks that have been super negative are continuing to get pounded in this market, and it's just going to get worse for them for a while yet, as I'm expecting for some activity here from the standpoint of economics is just going to maybe, as we get through the end of June into July, we're almost midpoint here in June. Maybe when we get into July, we'll see some interesting things, and maybe we'll see some things that start to slow down. But it looks to me, and I'll discuss this in a minute from the database standpoint, is that we're going to continue to see forward-looking positive tone in the markets. There's going to continue to be positive flow. So two things I need to talk about before we move on and get into the technicals is the first one is let's talk about the Fed. And I've been saying going back to the last meeting that I thought they would raise one more time. Then I think there's a pause. I'll find, we'll see what comes out of the meeting on Wednesday. Maybe at the end of the week, I will discuss this sea change and what I still believe the Fed is trying to do. And I've said this, I'll just mention it right now, that I believe the Fed is trying to normalize rates in the economy. And normalize means where they let them float where they need to be. And that's why you're seeing these fluctuations. And the data points that we're seeing, the volatility that we're seeing in the bonds is ridiculous. I mean, we're seeing one data point where one day the Fed's going to raise the rates by 70%. The next day it's 30, back to 70. We'll see what happens in the next couple of days. But the bottom line is those data points really are just traders, and that's how finicky the market is right now. So I'm continuing to expect to see the Fed raise rates this time. I don't expect them, they're pricing in rate declines later in like 6 months or so. That's not happening, okay? I'm pretty sure, and there's another point in time that I will discuss this in more detail, but I'm pretty sure that we're going to see inflation embedded into the economy. It's not going to be sticky. It's going to be more than sticky, I believe. There's going to be elements that are going to stay out there, and that's going to continue as we go into next year, into election year, all that stuff. So rates are going to be allowed to float. I don't think the Fed's going to intervene. They don't want to be in that game. I've talked about it. I'm already going down that trail too far. So just expect, and I'll set you up better as we come into Monday night stream and Tuesday coming into Wednesday. And I'll let you know, I'm not sure. I might actually do a live stream on Wednesday like we usually do on the Fed. I'll let you know on Tuesday when I do the video whether that's going to happen or not. There's some things that I need to review. And let me just look at my notes for the final thoughts on this. So yeah, I think I've got everything here. So let's go ahead. Let's get into the Wavetech database. I need to set up a couple of things there that's going to help you understand my perspective. As you know, I'm data driven on all of this. All right, so we're looking at the database here. The daily database, 63.41 bullish. I'll talk about the output of the models here, but we had 184 sells, but we had 498 buys on the models for the daily. For the weekly, you see them right here where my cursor is here, and the weeklies we actually got 1,074 new buys and only 204 sells. So we had a bullish ratio on weekly model 3.2. And I want to actually talk about that for just a minute here, is that the model 3.2 has the longest holding period. If you look at the map, you can't see it here, but let's go full screen. It's probably fairly small, but over on the top here, the optimized weekly data, 3.2 and 1.2 are 50-50 as far as it goes, but 3.2 has a little bit longer holding period. For instance, it has about a 221-day average hold on it versus the weekly of 170. And one of the things that I've talked to you about is that the forward-looking part of this database is important to understand, because we are right now, if we look at on an optimized level, we're right now fulfilled. We're only about 23%. If we look at the other two models, weekly 1.2 is on an individual level is at basically almost 30%, 28.6. and 22.5 on weekly 3.2, but on optimized, which is the best model for each, inside of the software, it actually tells you which is the best model to use on every symbol in the database, is completely mapped out. So what you have is a little more bias to the longer term. That's what's going to push the extension. Best way, it's going to extend the duration of the hold because of these 3.2 buys. So we had a lot more of those. Like I said, we had 1,074 of those from this. I'm sorry, 988 on this recent run. So that is suggesting that the markets are going to starting to extend that holding period a little bit. And right now, the average current duration is 48 and 46.7, and the average optimized for weekly is 204. So like I've been saying, we've got a minimum of 100 forward-looking days, maybe 120, and those are trading days. So that's the better part of about 6 months, about 5 months plus is the minimum. And if we continue to get this rotation into the 3.2 model, then that could extend that holding period out just a little bit further. So that's something to keep in mind. So this, from my opinion, and what's going on here with the database, we're going to see a continuation of this market sequence that we've been seeing for a while going on, and at least into Q4, maybe into year end. So let's go ahead and get into the technicals on the S&P. All right, we'll start off with the hourly chart here. And just for the getting extremely close, like a couple days close, I'm hoping by Wednesday that we're going to have the release of the new indicators no later than Friday, folks, but I'm hoping Wednesday will be the magical day. I'm very excited, but here, this is the market grid for Monday, and right now we're looking at, I'll get the exact numbers up here, but you can see this is the hourly chart, and look at the angle of attack here on the hourly. It's just continuing to go up. I'll show you the breakdown of the PPMs and all that here in a minute. But this angle is just still very much intact. So we're going to climb this level. We are seeing a bit of a contraction on the hourly of the market grid, which usually tells us that we could come down. Maybe we'll head back down into just down into this level. Now, this is the June contract, folks, by the way. I'm not if you go to TradingView and you put the ES in there and go to nearest futures, the ES1, you're going to get the September contract right now. They've already rolled over. I'm sticking with the June throughout this week. So if I come up with some strange numbers and they don't make sense, say something in the comment section, just so that in case I accidentally end up on the June contract. I shouldn't do that, but just in case it happens, I will do that. Let's go over here and take a look here with the PPMs. This is the same hourly chart. Here's the angle of attack that I was just showing you. Right now, PPM 1 is a 0.34, 0.20 on the PPM 2 is 0.20, PPM 3 is 0.26. So everything is in an uptrend mode. And it looks like we could see a little dip into London tonight and then look for a bounce, but it should stay. I would say use the SMA 21 as a very good support number here. That's right at around the 43 handle right now. We're looking at last print 43.11. So we opened a little bit firmer here on the reopen for Sunday. So let's go and take a look at the daily. This is also continuing this upward slope from the standpoint of that angle of attack, although we're seeing a little bit of a stalling out here, but we're still at right now 0.22, right at trend level 0.18. So we're not at this robust level, but I've been talking about this for probably 10 days now. As we've been climbing this up, we're just at a slow climb. These are very sustainable rallies that will continue on for a while, a lot longer than you think they will. And so this is what's set up here. It looks like we're just going to continue along these lines. And the primary demand line here is the 21 day moving average, which is going to set us right here at, let me get that value for you. It's right now 42.16. It's well below here, but the primary is going to be 42.68, and we're kind of back into that angle that I talked about, the 42.60, maybe 43.60 if we can get up there, and we'll see if we can print up there. Like I said, this is still the June contract that we're looking at. Let's go to the weekly. And the only thing I'm going to do here, I want you to see what the rollover is doing, because there's a premium of about 30 handles here. So if I go and just put the ES, I put it on here, you'll see that last week, because of that rollover, we were able to get up toward the S3 number. This week, if we look at the nearest futures contract, I do want you to have that perspective, because that's important to watch. So you can watch this June contract. These are valid numbers I'm going to tell you. But right now, we're looking at, from a market grid standpoint, we're looking at 43.75 is R1, 44.05 all of a sudden comes into play this week. And if you recall those Fibonacci numbers that were out there a while ago, were suggesting for a move here. Let me get those up on the page here. 42.59, which we've exceeded, and then 44.19, 45.18. So those are my upper ranges right now, 44 to 45. We'll call it 44.20, 45.20 range. So we should see a continuation up into this pattern. It just doesn't want to quit, and it's not going to quit as long as it's got to punish a few more people, it looks like. And my old saying is the markets always go in the direction of that can hurt the most people. All right, so we'll go to the NASDAQ, and we're looking at the pretty amazing number. It's a weekly. We'll start weekly. We'll go back to daily. But the weekly still is at 1.17. 0.25 is an uptrend. So this is 1.17. This is in the extension level of this chart. Let me see if I can bring something up quickly for you, because I've shown you this quite a few times, but I think it's pretty appropriate right now. Let me blow this chart up. So this is where we are. When we get in, this EXT stands for extension. When we get into this 1.17, we're in this, we've been, since that number's been above 1%, we are now in a extended pattern level, and that's what we're seeing here. If I come back here and go to the chart, what you see is that the NASDAQ is in this extended pattern. So it's going to continue to extend. It looks like it wants to try to top out. If you recall, going all the way back to April 10th, the Fibonacci projections were 14,005, 14,844, and 15,563. Well, we printed right up there to that 14.8 level. We printed 14,844, and now there's still one fib target in play. 15,363 is still a possibility. And if we just look at it from a weekly market grid, we'll go to daily here in just a second. But if we look at it from a weekly market grid, we're looking at right now at R1 14 14,876, R2 15,034. So R2, R3 is possible this week. And we still have, like I said, we're at 1.16 on that PPM1. So that, and also PPM2 is in that extended pattern as well. So there's this thing, as much as folks would like you to believe that it's topping out and ending, it's still going strong. There's this trend is very much alive. It could start to go sideways in here, but it's still in that angle of attack. It's still looking like things are going to improve as we go down. Let's go to the daily. Daily, we almost got an RXT sell on Friday, but we're seeing some of the PPM starting to flatten out a little bit. So there's potentially a retest of the 10-period moving average on the daily coming. That's right now 14,526. Last trade here, 14,770. So we could print down there. We also look at the market grid on a daily. You're looking at, looks like R2, 14,590, R3, 14,514. So that's put us right into those moving averages, that 10-period moving average. So that's possible. If you look at what the algos are doing here, I'll just expand this PPM1. You can see that it's breaking through its second derivative. And what that suggests is there's a potential for a penetration of the 10-period moving average. So be watching that closely. And so this week, on balance, what we could get is sideways, and there is potentially building some kind of downside patterns here in the markets. Very, very minimal, but the NASDAQ is likely to have most of the negative events, I think, there, just because it's been such a leader. And I would look for the next chart. Let's go to the Russell. All right, so the Russell, still see that big angle of attack. Remember how this was just sideways forever. And in fact, we talked about the entire consolidation range for the last year and almost 2 months now. This pattern is finally breaking out. We're well above the 200. This is daily now, 200-day moving average. Look at the PPM 200 down here. It's exploding to the upside. So what's happening, what is telling you internally what's going on with the 200 period moving average is it's starting to turn up. And it's been basically flat, rolling down, and now it's back up. It's turning back up again. So if it can sustain that, then we start to see a larger trend to the upside start to happen. And if that occurs, then we're going to see the Russell continue to outperform, and that is likely to continue as we go forward. I just want to touch on all the weeklies as we set up for this week. The weekly Russell, this is RTY. So the weekly Russell has 3 fib targets on the upside: 1990, 94, 2103. Let me get this. 1994, 2103, and 2170. That's these dots that are up above here. We're seeing some acceleration, not a ton, but we are seeing some acceleration here. And we're at 0.58 all of a sudden on PPM1, which we're in trend mode there. And this is on a weekly basis. So it's likely to continue to see this pattern keep crawling up these moving averages. Over the next couple of weeks, we should see them all turn up pretty substantially. Well, this is the interesting part, folks. I think what we're seeing here is, I've been talking about this, if you look at let me expand this pattern out a little bit so you can see the moving averages are being projected to roll over. The only way that can happen, if we're going to have to trade below the value of these moving averages, and that's at 356 just looking at all three of them. 366 is the 40, 360 is the 21, and 356 is the 10. So it looks to me, so maybe the Fed pauses, but what's being projected here is lower rates on this segment of the curve. And I believe when we look at the 2-year here in a minute, we'll see a similar type pattern from that standpoint. So just continue to expect to see at least staying within the context that this is a weekly. So next couple of weeks, we probably stay right in the 360 range. This is down the road. And these predictions get a little foggy when you get about 3 weeks plus out. So right now, I would argue they're going to stay sideways, and we stay into that range. Don't see a lot of downside if we just well, let's take a look at the 2-year. The 2-year is still, this is an interesting contrast. The front end of the curve, the two-year is still looking like it wants to move higher into the pattern. So that would suggest, maybe some flattening in the yield curve. It's going to be, like I said, this is Fed week, so it's going to be interesting to see how this unfolds. But the 2-year is projecting higher. This 5 with the arrow that you see there is the STX buy counter, and it's pretty accurate on certain markets, and I'll be talking to you about that when we release this indicator that's coming up pretty soon here, is that you'll see when you get these multiple STX buys, that's what this STX counter, it'll let you know when there's a certain amount of buys, and you can test out which ones, how many works really good with the markets. For instance, a STX buy 5 counter, I'll explain how it works later, but on the S&P came out 2 days before the low in October of last year. So we found, one of my old associates is the one that actually ran this one down and found that if you get 5 STX buys without an offsetting RTX sell, then it's a valid buy signal, and it is called multiple major bottoms in the markets. And it also works on intraday. I've been using it intraday on a 5-minute chart. It's pretty cool. I'll be talking to you about that. But this pattern, what we're seeing here, right here, was that was the last pattern that happened, and now we're seeing it's starting to move up. So the 2-year is still positive. There's still potential of 5% on the 2-year, and that is very, very likely to continue up. So maybe there's a little bit of a steepening, and maybe that lends to the Fed keeping the short end of the yield curve higher, and that's why the 2-year's being bid up, and the 10-year is not following through, at least being projected. So we'll see how this all plays out. All right, so we'll look at crude oil next. Crude oil's got a downward trend being projected. ppm1 is at a minus 0.43, so it looks like potentially more downside. We've got some fib targets underneath here. Fib targets right now 60, 65.23, 58.24, 53.92, and so we're just seeing this downward slope coming in here, so maybe that will bode well for expectations as we go forward with CPI and PPI. But this looks to me that this is going to continue in a downward trend, and PPMs are confirming that with these huge downward slope angle of attack on the downside. This is weekly, so let's take a quick look at the daily. Daily has, on a shorter term basis, We do have a fib target down at 67.36. The PPMs are trying to turn up on a short term level, so that just tells you you're going to trade back in toward these moving average, which are about 72. So look for market to trade within the market grid here. Over on the far right, I've got the market grid up there. R2 is 71, R3 72.23, 71.50 R2, and then we're looking at S2 68, and then STX is that 67.47. All right, we'll take a look at gold next. This is the daily. Daily is just kind of consolidating right in here. Very neutral on all the PPMs from that standpoint, so nothing really there. The only thing that is there, if I expand this out, you'll see that there's still a Fibonacci target down here at 1848, roughly 1851, the 200-day moving average right now, 1846. So a lot of things are projecting to that. Let's take a look at the weekly. And weekly still negative. I've been talking about this for a while, and it continues to be valid, is that we should trade between the 21-week and the 10-week moving average as a resistance point on the upside. And PPMs are confirming that that upward resistance is going to be persistent. The PPM 1 down 0.26. We look at that, 1989 is the 10-period moving average. The 21 is 1949. And so we're looking at that being the range, about not quite a $50 range, like a $40 range where we should stay within. But the bias is to the downside. So right now, just know that watch for a penetration of 1949. If we get that, next stop is down into these fib targets down here, potentially at the 40-period moving average at around 1850, 1860 level. All right, last market we'll cover is Bitcoin. This is the weekly. Bitcoin, as we've been talking about, has a similar formation. The 21-period moving average, 26,000. Right now, we're looking at trading just below it right now, so we're breaking down. It's very possible we're going to see Bitcoin down around 24, 22 range, down toward this 40-period moving average. There's at least 2 more weeks of weakness coming in. And I guess with the attack from the SEC and on crypto and everything right now, folks are a little bit nervous. And I think that I'll talk about this when I come back up for the end of the show today. But I think there's potentially, I'll talk about the SEC situation here in a minute. But the patterns still look like they're down. If we go to the daily, just expand this just a bit. Daily's got a very mixed view of the world. It's very flat. We've got resistance right overhead here right now at the 26.5, 26.8 level, all the way up to 27.1. We do have some Fibonacci targets, but there's no momentum. In fact, it's really a squeeze to the downside, and I think the weekly charts are going to dominate from that standpoint. Okay, folks, that's going to do it for tonight. So let's talk just for a minute about this SEC situation with the Bitcoin and crypto. They're really attacking things, whether it's trying to get ready for the CBDC, whether that's going to happen or not. Maybe that's part of their effort to do this. But here's ultimately what they're trying to do and what's likely to happen, my opinion, is that they're really trying to get everything under the SEC control and make everything registered. So they're attacking. The attack on Coinbase is kind of bogus. Maybe some of the other attacks on some of the exchanges are legit at some level, but they really want everything to be underneath the SEC and under the umbrella. So now everything becomes a security, and probably the big players that end up coming, the big players, the big banks and the big brokers are the ones that end up covering this stuff in the end. So the SEC is moving everything over to their regulated, all the money that flows off of the Bitcoin and all that will be on all the super regulated people and these other exchanges they would like to see shut down. We'll see if I'm right about that. Anyway, folks, just a quick reminder again, I may be late tomorrow. I'll give you a tweet ahead of time, let you know that I'm what my timing looks like tomorrow. It looks like maybe an hour late. Don't think it'll be much more than that, but I will show up tomorrow. And I just have something I have to deal with in the afternoon. And other than that, I think that will do it. I wish everybody a great week. I'll let you know whether I'm going to do a live stream on Wednesday on the Fed or not. We'll set everything up as we go through the week. And I think we're going to have another exciting week in the market. So thanks for watching. Appreciate it. I know it's early, but this is trying to get something real efficient that works for me and still gets lots of information out to the community. So thanks again for watching. We'll talk to you real soon, like tomorrow. See you then. Bitcoin will become a security. Watch.